Welcome to vTalkInsight, Risk Sentiment Daily for January 26, 2026. Markets are juggling an AI-powered growth surge, stretched valuations, and a spike in safe haven demand, leaving risk sentiment cautiously constructive but far from complacent. Let's unpack what is driving risk appetite across equities, credit, and commodities today. Risk sentiment today is best described as cautiously risk-on, with investors still willing to add risk, but much more selective about where they do it. The S&P 500 is essentially flat on the day while holding near all-time highs, and volatility gauges sit in mid-teens, signaling two-way trading rather than a decisive rush for the exits. Underneath the surface, strong U.S. growth, a productivity pickup, and an AI-driven capex cycle are providing a solid fundamental backdrop. That strength is feeding into double-digit earnings expectations, broadening sector participation, resilient credit markets, and rising flows into emerging markets and cyclical assets, all of which support a constructive bias toward risk. At the same time, a mature bull market, stretched valuations in U.S. equities and parts of AI, and visible stress in mega-cap tech are clear warning signs. Layer on elevated bond yields, surging gold and silver prices, energy and weather shocks, and persistent geopolitical tension, and it is clear that this is a hedged, not carefree, risk-on environment. With that framing, let's look at the main bullish and bearish forces shaping this cautious optimism. A central bullish driver is the AI-driven growth and productivity boom reshaping the macro outlook. U.S. nominal GDP is running around 7 to 8%, with forecasts for real growth above 5% in the first quarter, supported by significant investment in AI and technology. Recent productivity readings near 4.9% suggest companies are producing more with fewer inputs, supporting profit margins even as wage growth stays positive. Massive capital spending on data centers, chips, and power infrastructure, alongside AI-related goods accounting for a large share of global trade growth, underpins expectations for double-digit earnings expansion and a constructive equity outlook. The story is not one way. Higher productivity can also fuel spending and inflation, prompting calls for higher real interest rates if price pressures fail to moderate. AI-driven automation is already contributing to a softer labor market, raising the risk of a demand shock that might ultimately require policy easing to offset job losses. For investors, the key watch points are upcoming earnings from major AI beneficiaries, the durability of capex plans, and whether productivity gains keep outpacing the inflation that they help to create. Another supportive force is the broadening earnings strength and sector rotation away from an over-reliance on mega-cap tech. Value and momentum factors are outperforming, with value stocks beating expensive names and high-momentum shares outpacing low-momentum peers year-to-date. Cyclical sectors such as materials, energy, industrials, and financials are benefiting from expectations of a manufacturing capex cycle and onshoring investment, with industrials seen delivering mid-teens earnings growth on credible assumptions. Emerging markets are attracting record inflows as they outgrow developed economies, while defense equities and recent defense IPOs are trading strongly on the back of structurally higher military spending and robust order books. Crucially, many of the new leaders, including value, small caps, and emerging market tech, trade on far lower price-to-earnings multiples than U.S. mega-cap growth, so even modest earnings progress can have meaningful impact. However, this rotation also reflects stress in previous winners, especially large-cap tech, and could reverse if growth disappoints or rate expectations shift abruptly. The takeaway is that market breadth is improving, but leadership is more fluid, increasing the premium on careful sector and regional allocation. A third constructive driver comes from supportive credit markets and moderate expectations for Federal Reserve easing. Markets are currently pricing in roughly 40 basis points of rate cuts for the year, effectively one firmly expected cut, and debate around a second, consistent with a soft landing narrative rather than a sharp downturn. Despite record or near-record investment-grade issuance, credit spreads have tightened, and demand for high-quality bonds remains robust, signaling confidence in corporate balance sheets. High-yield credit is outperforming, regional banks and small caps are breaking out, and overall credit conditions appear to be easing rather than tightening. There are, however, important caveats. U.S. Treasury yields sit near their highest levels since September, and some argue that monetary policy is more accommodative than the Fed believes, implying real rates may need to rise if inflation reaccelerates. With the next Fed meeting expected to keep rates unchanged, attention will focus on guidance. Any hint of a higher-for-longer stance could challenge this supportive credit backdrop. On the bearish side, stretched valuations and a mature bull market are a growing concern. The S&P 500 is trading around 22 times earnings, profit margins are at record highs, and earnings growth expectations sit nearly twice their long-term averages, leaving limited room for disappointment. Valuation anxiety is not confined to equities. Gold has experienced a parabolic rally toward $5,000 an ounce, and silver is hovering at record levels, prompting some investors to hedge upside through options and warn of a sizable potential correction. Within AI and big tech, rich multiples and rapid multiple compression in some names highlight how quickly sentiment can swing when lofty narratives meet reality. Combined with indications that this bull market is already twice as long as the historical median and that positioning has been stretched, the risk of multiple compression is rising even if earnings remain solid. That does not preclude further gains, but it does suggest that forward returns are more asymmetric, with the market more vulnerable to negative macro or earnings surprises than it was earlier in the cycle. A second key headwind is the tech-led drawdown and rising AI earnings risk. Intel's shares plunged more than 10% after management flagged ongoing manufacturing setbacks, yield issues on advanced nodes, and a subdued revenue outlook, wiping out tens of billions in market value and raising broader questions for the semiconductor ecosystem. Large-cap tech more broadly is under pressure. Apple has logged 8 consecutive weekly declines and double-digit percentage losses over 2 months, while concerns are mounting that Microsoft's massive AI infrastructure spending and supply constraints could weigh on near-term earnings. Options markets are signaling heightened uncertainty, with implied moves around upcoming results for Meta, Microsoft, Tesla, Apple, and others notably elevated. Structurally, AI remains a powerful theme, with companies like Microsoft and Google still viewed as central infrastructure providers, and some megacap names now technically oversold, opening the door to tactical rebounds. Yet, more asset-intensive balance sheets, growing dependence on debt financing, and unsustainably high compensation for AI talent increase interest rate sensitivity and execution risk. The near-term balance for tech is therefore skewed toward higher volatility, where earnings seasons can drive sharp two-way moves rather than a smooth continuation of past leadership. The third major bearish driver is the mix of geopolitics, yields, and safe haven stresses. In Japan, a more hawkish central bank stance and volatility in long-dated government bonds are pushing yields higher, with markets anticipating gradual but persistent tightening that could ripple through global curves and currencies. The yen remains weak, driven in part by carry trades, leaving it vulnerable to any official intervention that could trigger a sharp unwind and cross-asset volatility. At the same time, U.S. political and fiscal concerns are feeding into higher term premiums, a weaker dollar on the week, and a rally in emerging market assets, illustrating how policy uncertainty can simultaneously support and unsettle different parts of the risk spectrum. Safe haven demand is intense. Gold and silver are surging, central banks are adding to reserves, and investors are rotating between precious metals exposures as they reassess risk. Energy markets are also flashing stress, with natural gas prices spiking more than 70% on severe winter weather and supply disruptions, alongside warnings of power outages and logistical bottlenecks. All of this is occurring as correlations between equities, bonds, and commodities rise, complicating diversification and suggesting that geopolitical or policy shocks could have more systemic cross-asset impact than in calmer periods. Putting it all together, today's landscape is one of cautiously risk-on sentiment anchored by an AI-driven growth and productivity boom, broader earnings strength, and supportive credit conditions, but tempered by stretched valuations, tech sector fragility, and rising geopolitical and yield-related tail risks. For multi-asset portfolios, that means the balance of opportunity and risk is shifting beneath the surface, with leadership rotating across sectors, regions, and factors, while safe havens and correlations send a more nervous signal. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.